Everyone, the goal over the next 25, 30 minutes is to speak about what is not public, about the reality of heavy equipment. And specifically today, we're going to speak about the cost of money, the finance, and how all that bubbles together, what that means to buy, own, finance heavy equipment, and speak about everything that is not public. I have a commitment to everybody on that? Nice. So, very briefly, my name is Clement Kezalot. I'm a co-founder, CEO of Machinery Partner. At Machinery Partner, our goal is to make heavy equipment ownership easy. Making it easy, that means helping you find the right equipment, fund the right equipment, and fixing it. Here I brought together David, Tim, and John, who are experts respectively on the selection, the financing, and the support of this equipment. And we're going to speak about money specifically. Let's start with our beautiful guest. John, at a high level, who are you? What does financing, funding heavy equipment means?
Yeah, thanks for having me, guys. John Pfister. I am one of the co-founders and the chief executive officer at Mazo Capital Solutions. Founded the company in early 2021 on the heels of the pandemic. And equipment financing is funny. People kind of get into equipment financing and don't really realize how they've gotten themselves into it. Tim, I'm sure you can relate from your experience, but it is a massive industry. It's a massive industry that no one really knows about, right? It's a $1.34 trillion industry. 82% of businesses in this country finance. And I think that there are a lot of misconceptions, a lot of old ideals, I'll say, about equipment financing that have changed in the modern era and have changed really in a post 08 crisis and also post pandemic world that I'm happy to unpack with you guys here. So we'll save the rest for the rest of the conversation here, but happy to be here.
Beautiful. And for that conversation, you're the one doing fist fight with every single lenders to make sure that the client gets the best rates, but also the best terms, and explaining what that means. And so we'll go really deep on that part. Thank you, John. So, Tim, you run Machinery Partner Capital. At a high level, who are you? What are your street creds? Why is your haircut so beautiful? But most importantly, what does that mean for you to navigate finance between the end clients and the vendors themselves?
Awesome. Thanks, Clem. I really appreciate it. And thank you, John, for joining us as well, too. And David, too. Excited to go through this today. Yeah. To your point, John, yeah, I came out of a psychology degree. So we all fall into this industry somehow, some way. But I started running credit applications at a small equipment finance company 25 years ago. And kind of the rest is history. Kind of developed through that company. Found out I really enjoyed it, stuck with it, built out some credit models and some credit platforms, built a business on the sales side as well, too. Then suddenly got the taste for working with venture capital companies. Clem and I crossed paths on what we were both looking at doing, building a fun platform that actually makes financing easier and enjoyable, I think is kind of the idea, along with getting the right money for the right people at the right time. And I think that's what we're going to talk about as well today more too. So I'm super excited to be here. So back to you, Clem. Thank you.
And last but not least, David, the one and only. So I'll ask you two, three questions. I'll ask you who you are, and you've been in so many parts of the industry, but also I'll ask you to recap what is Machinery Partner for everybody, and when it pertains to that conversation, and we'll jump on what's going on in the market right after.
Yeah, awesome. Thanks for having me, guys. My name is David Blair. I am a mechanical engineer and have worked in the industry for many years at Caterpillar and John Deere and other great manufacturers around the world. But I'm also a technologist and I care a lot about factories. So it's a great marriage of my background to be here at Machinery Partner. And, there's so much to do with data, AI, just streamlining workflows. We are thinking about all of these problems to ultimately build a great online platform to help factories move more equipment, buyers to get access to the equipment they need faster, better, easier, and partnering with great companies and collaborators like John, Tim, and Clem to build out this platform that we're excited to bring to market.
Nice. Making ownership of industrial equipment easy is really, really hard. So let's jump in, zoom out a little bit. We're in June 2025. There has been the most volatility there has ever been in the global supply chain, there are like key structural changes in the US market on how we think about equipment, investment, financing, and that has a lot of worldwide ramification. We're on the heel of multiple wars all around the world that are themselves disrupting supply chains, because every piece of heavy equipment is on average 10,000 pieces of small pieces that are assembled most of the time by hand. And if a single piece is missing, the whole machine is stuck. So that's the reality of what's happening right now. Where something in Eastern Europe, in Asia, like has massive ramification in places that aren't expected. So let's speak about that a little bit. David, I'll give you the ball here at a high level to speak about what you put from a manufacturer standpoint. What is the impact of that volatility? And we'll go in what is the cost of it, since that all bubbles down into financing, because when there is margin, you can subsidize finance, you can lower the rate. But if there are no more margins because of that volatility, then that is changing the game for everybody. So, David, can you elevate a little bit the discussion? What's happening in June 2025 in the global supply chain of heavy equipment? And let's focus not on what Caterpillar does, but what everyone that is not Caterpillar is going through.
Yeah, I think to sum it up, factories are trying to figure out how to get to market better, and there's lots of, I'd just say, friction going on right now. And maybe just a quick little story. I got a call from a manufacturer who said, "Hey, we just built the machine. Should we ship it or not? There's a whole bunch of tariffs that are imposed on us. What do we do?" And so factories are looking for how to navigate this. And it's not just with tariffs, right? Tariffs have caused, instability of just people wondering how to navigate it. Should we raise our prices? Should we not raise our prices? I think there's also just the supply chains of logistics. There's a lot of confusion at ports. We've seen ships come pick up a load of equipment and then like turn around and put it on the ground. And like, it's because there's labor problems, there's congestion at ports, there's a number of things that are going on that are causing just supply chains to be a little bit in turbulent mode right now. And what's exciting though is that there's a path forward to navigate this, just using data, using good common sense. But we're seeing a bunch of stuff on the tariff side, the logistics side, that are just causing a little bit of uncertainty with buyers and sellers.
So what does that mean for the margin of a manufacturer? On average, what's the margin of a manufacturer?
Yeah, roughly 30% is what manufacturers err towards.
So they ear toward 30%, under which they absorb. So they basically, when you build a machine, 18 months in advance, you're ordering your engines, you're ordering your steel, your parts, you're placing orders for multiple machines. You're aiming at roughly 30% across currency. You're placing orders, you're pricing 18 months in advance what's going to be, and you hope that this 30% is going to absorb all this volatility for you.
Right. And there's a trickle down effect all the way down the chain, right? So if you're an OEM that needs an engine and that engine is delayed, well, that engine may be delayed because a journal bearing was not produced at a factory that was relying on steel that may have been delayed, or so it's just this ladder on effect that causes this turbulence. And so lead times get affected, prices get affected, and yeah, we have to navigate it.
So walking back from that, right now let's speak about the US market specifically. The goal here is to unpack what that means. So you have manufacturers that have created a buffer of 30% in and out. Do you mind giving a high level of what does that mean right now in the US market, the Fed outlook? What does that matter?
I was at a meeting last month for the Equipment Finance Connect, and they had Martin Lavelle from the Federal Reserve Bank of Chicago talking, giving kind of the outlook of the entire industry as a whole. He kept using the same word over and over and over. To your point, David, it is uncertainty right now. There's a lot of variables in the marketplace. So it was a repeated word that kept coming up over and over, because I think of all the different values that you mentioned, like inflation and tariffs and deportation, raising labor costs, all these things leading to tighter margins, I think, from the manufacturer level all the way down to the distributors, and then, of course, to our end users. And trying to solve these uncertainties, that is our mission, I think, here today, right? That's what we're trying to solve. So, John, have you seen more of this as well, too?
Yeah, I mean, on the heels, I attended Capital Connections with the Equipment Leasing and Financing Association. So we're on the Hill we had the big beautiful bill, which we can touch on a little bit more in terms of what that means from a kind of a tax advantages perspective for businesses in the United States. But the overall tone on the Hill, so the big beautiful bill had just passed the House and was sent over to the Senate, which surely it was going to be revised and then sent back to the House. But overall, between tariffs, between tax cuts, but also increases in government spending as a result of this big, beautiful bill. We're looking at obviously treasury yields going up and long term confidence in the US economy kind of trending downward globally. And so the overall cost of financing right now and the overall cost to borrowers is higher and likely is going to remain higher for an extended period of time. This uncertainty trickles its way into the treasury markets and into the overall kind of borrowing costs for banks and for independents. So uncertainty is probably the best way to describe like where we currently are, and I don't know that there's any end in sight or some date in the near future that we can point to as like as providing clarity.
Perfect. So let's unpack that and zoom out. So if you're manufacturers, you actually mark up your equipment by 30% in order to absorb this volatility that is arriving. Right now, there's the greatest period of volatility that there ever been. I saw that in 2020 with COVID. We saw that like in 2008, 9, 10. So that 30% is right now looking more like 15% on the manufacturer side. Why does that matter? That buffer is also made to pay for the warranty. Paid actually is to subsidize the dealers so that they can bring in their own inventory more gears, more equipment, so that people are more successful on the other side. And right now, that is going away because people are basically selling at break even and or at a loss that equipment, because on this 15% we're supposed to pay overhead and everything. And right now that is actually shrinking and shrinking by the day with that volatility. So let's speak about why financing matter. Right now, supply chain disruption means for heavily complex non-commodity items, there is less and less money going around. As a result, that means actually the more specialized you are, the more the selection, the financing, and ultimately creating enough margin for everybody so that people can fix and keep this asset up, keep the uptime of the asset up. That means people can make their monthly payment is critical, and everything is being shrinking. For the industry, this year will be a run at cost type year so that we set clients up for success in the future. John, I'll put you back to you. What is the shift right now that you're seeing, and what is the stuff that aren't told between vendor financing, what is vendor financing, local credit union financing, and independent finance? Can you explain to us what these three things are and a little bit of changes you see?
Yeah, absolutely. So to unpack this fully, if we look at vendor financing, or let's call it captive financing, right? Manufacturer captive financing. Generally speaking, there are a few players that have internal balance sheet funding capabilities at the manufacturer level, but a host of other manufacturers that have outsourced their basically the captive arm have outsourced it with a partner bank, right? So you look at a JLG, for instance, that works closely with Leaf. Leaf kind of powers JLG Financial and provides subsidized financing, subsidized leasing for JLG equipment that's purchased. Then we have independents, right? So independent equipment finance companies are generally, and we're seeing a massively rising trend in private credit entering into independent equipment finance companies. So that's anything from private equity firms to insurance firms to pensions to family offices, high net worth individuals and family offices that are putting their money to work because of the combination of kind of risk and yield that equipment finance offers, right? So
Let's explain that in plain English. So what I heard you say is, if I lend money to an individual to buy a house, I'm banking on them to have an income and stay employed so they can pay their bill. In the commercial world, because I'm actually banking on you running a business, thus producing income, and so you have an incentive to keep paying, because the more you pay, the more you generate money. That's why people are excited. And like personal finance is actually a race to the bottom. Who has the lowest rate? It's heavily regulated in the US. There is plenty of structure, so there isn't much money to do. There's a lot of volume, but not much money. And commercial credit, which is what we said, is this combination of yield and risk. There is an asset. I'm financing an excavators, a rock crusher, a shredder, whatever is the specialty stuff. So there is a physical stuff, and I'm incentivized to keep paying because I make money out of that, and there is this symbiotic relationship, because that's what you see. New player coming in to fill the gap of vendors who are not able to subsidize these rates anymore.
Yeah, I mean, there's money on the sidelines, right? There's private money that historically has bought treasury bills, right? Or historically has put all their money into equities or into real estate. And you see that there's volatility in the equities market, right? You see that, yes, while T bills are a safe investment, that yield on a T bill is still not enough to kind of get you excited. And so equipment finance and commercial finance in general presents a really good opportunity for an investor to buy kind of a fixed income investment, right? You have a 60-month payment at $3,500 a month, and you have kind of an expected yield on that on a monthly basis. It's also collateralized, so there's an asset underpinning that loan, which means that you get higher yield than a bond or higher yield than a T-bill with a bit more risk than a T-bill, assuming the United States government doesn't implode. And on the flip side, in the equities market, you get a little less yield than alpha in the equities market, right? With, I would say, less risk. You have an asset that underpins it. And in today's world with the equities market, and anyone looking at like what the stock market's been doing, we know that it's going up and down pretty much every day and 5% swings one way or the other. So it's really tough to financially kind of forecast. The last piece, and one that we haven't mentioned, and the third one, Clem, is banks, right? And bank finance groups that obviously are collecting deposits and taking deposits in from their customers and then lending that money out into various areas. And a number of banks have been historically the biggest players in equipment finance, right? Obviously 23 and SVB and Signature Bank.
We used to bank with Silicon Valley Bank, so
Right.
please don't say too much about that. No, I'm
So
kidding.
that's caused a retrenching, and it's caused like a reimagining or I'd say they're re-strategizing how they want to deploy capital, right? And this has created this massive window for independence to rise up and take market share.
If I recap, is manufacturers make less money than ever. At the same time, the US market, through a series of changes, you just flag Silicon Valley Bank going under, all that, like you have local players that are less equipped alongside the traditional vendors, since they have less margin, are less equipped to finance. You flag GLGs that is using external financing, and so many others are doing that. As a result, right now there is a rise of new player entering into the market who want to partner with local businesses in order to provide finance, which aren't your traditional credit union, nor your traditional equipment vendors behind. That's awesome. Tim, let me go into one specific piece of your experience. We build Machinery Partner Capital together. What that means is multiple options. And then we'll actually go deeper on how broker and lenders work. And David, you're going to speak a little bit about the technology, and we'll go in different parts of like the matchmaking, and John, the magic you're applying, and like speaking about portfolio, it's about you, but also the group of people coming from, all that piece. So, Tim, you've navigated that ecosystem for a long time. Why, as Machinery Partner, did we have to create Machinery Partner Capital?
Yeah, it's a great question. It really is kind of the crux of what we're doing here. John, to your point, having just a bank doing what they've done, like for prior decades, you'd be just pick up the phone and call your banker and get your loan and on you go. But I think between the credit profiles in the marketplace right now that have changed so much, as well as the bank on the flip side, their credit appetites have also changed at the same time. It's made a lot more mismatches, I think. The banks are over here wanting this and the customers over here, and we're not aligned. So there's this need now for customers to go have to shop for financing. And I think one of our missions we discovered early on, I think Clem, even before I arrived, you and John sat down and realized that having multiple lenders bringing different appetites really solves a bigger picture and a challenge that the industry's had for a long time. And as a company, for us, as Machinery Partner Capital, supporting Machinery Partner, it really is giving our customers a better buying tool. And that's what we ultimately want to have for them, is that experience that's easy and simple. And by having a one-stop shop they can go to get their financing and their equipment that does the lender shopping for them, I think that's really our bigger picture of what we're trying to accomplish here.
Continue on that. Like, how does broker and lender works in general? So it's about, and by the way, Machinery Partner Capital is powered by Mazo Capital. That's why John, like, we're deep into it together in so many ways. So high level, how does a broker work And what is the difference with a lender?
Yeah, absolutely. So brokers typically will go out and shop and find as many different lenders as possible for one customer at a time. Sometimes they're partnered with vendors and manufacturers like us. Other times they're independent and going direct. Then having a direct lender and a partnership like what we're working with John at Mazo, he is a lender. He has many different lenders underneath him as well too that he can syndicate to, but it makes a one-stop shop under his one umbrella. He holds all of those different relationships for us, and perfect segue claim to our partnership that's made this key. Mazo really has brought something unique to the table to us. And it is a strategic, and John, you can talk about this more, I'm sure, of course, but you didn't just bring any lenders to the table. You were very strategic in who you brought to the table, I think, for this as well, too. You know, in the trucking industry, certain people are going to play in that long haul, others will only play in the short haul. And bringing that wide map that covers everybody, I think, is what you guys have done really, really well, and has made us also successful at the same time too, to cover that map.
So, John, bring us in the underbelly of what that means to create programs. Why not? Like, why don't you work with a single bank? Why do you build a lender network? Why do you have different options? Why does that matter to me as an end customer?
For Mazo, having internal funding capabilities and having the ability to fund transactions, to pool transactions and sell transactions in tranches, right, gives us the ability from a process standpoint to make a streamlined and easy to use process for both the seller and the buyer. Priority number one is to make sure that working with us is easy, right? That we are a partner that you don't like get through your finance purchase and you're fatigued and you're pissed off about how things went. Having a lender network underneath it, we want to make sure that when there are a range of credit profiles, and I spoke about that mix of credit, of appetite, risk, and yield, right?
John, what is a credit profile?
Credit profile is going to be a combination in commercial. It's a combination of commercial credit, which is generally ran through PayNet, owned by Equifax. It's kind of the definitive source for commercial credit reporting nowadays. We have obviously personal FICO of the owners, especially in a closely held or small business. We have time in business, which generally speaking, the longer you've been in business, the longer you've kind of run your business effectively, the better it looks within the credit markets. Um, and then overall, kind of the content of those credit reports. So how much have you borrowed? What's the length of borrowing? What was your payment history on those transactions that you financed in the past? So the credit profile is kind of a combination of several different factors that really you try to kind of parse down to an A, a B, a C, and a D.
What you just shared, that is actually not well known, is every business has a credit number. Same way every consumer in the US is rated. Every businesses in the US is rated. But because this is a more opaque structure, it's not just when you borrow your house or your car, it's purely your credit profile. Here in commercial finance, it's a combination of your business credit score alongside plenty of other factors, including the size of the loan, the quality of the vendor, the quality of the lender or the wholesale lender or the broker bringing the deal. Like you have all these different facets coming together to actually give this rating.
You can be on a $40,000 transaction as a business. You could be an A credit on a $40,000 transaction. On a $180,000 transaction, you could be a B minus credit on a $180,000 transaction based on borrowing history. And it doesn't mean like in the personal space with your mortgage, right? If your debt to income ratio exceeds a certain percentage, it's just declined. In commercial, that becomes this is a higher risk loan. We need to appropriately price this transaction with a higher yield, right? So you can still get a deal done that you wouldn't have previously.
Let's speak about the stuff that's not public. Margin in the industry aren't public. The fact the whole finance market of equipment finance has changed over the past 7 years, absolutely not public. And the stuff that is not public is that right now with the rise of new technology, new AI, all that, because people are pre-ranking your company without you even knowing it. If you're a big company, it doesn't matter. You finance on balance sheet, you finance out of things where people don't care what you buy from because they underwrite the overall cash flow of your business. But the second it's a per transaction basis, it goes through data and through this shadow opaque world that as an end customer, you don't have visibility on. So David, you're the most accomplished technologist I've ever had the chance to work with.
Thank you for the compliment. Yeah, I think you know what everyone's talking about here is like matching lenders with buyers, right? And buyers want the best rate possible from a good lender. Lenders want to protect on risk and make sure that they got good borrowers that will repay their loans. And the fundamental thing that underpins all of that is great data and understanding, is this a good prospective person to give a loan to, right? We heard about credit pools A, B, and C. Well, it really, we're trying to build a profile around who this person is, and that is leveraging all kinds of databases. It's enriching the data to understand not just like, did they repay their loans, but like, how many machines have they owned in the past? Have they taken out loans in the past, and of how much? Where do they live? What other assets do you see? Again, this is not personal credit where you can just look at your personal FICO score. It's like you got to build a story around this business. And that is all using data and tools to enrich that data through AI, through databases we have access to. And so when you start that journey of acquiring or starting a loan, we're starting to pull data so that we can really build the best story around you as a customer to get that loan. And then on the backside, the lenders are all looking at that data to be like, how do I interpret this for the best underwriting that I could do for this customer to get them the best loans that they'll want to work with me. So it's really a great story. And Tim, you're seeing lots of this, right? Like you're seeing this sort of technology enablement really starting to explode.
Yeah, absolutely. As at that same conference I mentioned earlier, the Equipment Finance Connect conference in Nashville, several different technologies emerging and coming out of the woodwork that are fantastic. A couple of them in particular, Kaj AI, they're doing some great stuff with underwriting and automation and pre-screening and things like that. We're leveraging their AI to help us make sense of a lot of data very quickly. While it's not replacing the underwriters, I don't think it's not going to do that. And it's starting to help on decisioning. It's really a tool that's enabling acceleration and better decisions right now, which is really exciting for the industry. So we've got all this emerging technology happening at the same time as all these other challenges. And I think the crossroads with partners that have multiple lenders, there's really a great opportunity to take this technology and that data you're mentioning, David, and really harness it and harvest it as well too into something really valuable in a really simple way for the customer. Behind the scenes, complex lots happening, but that customer experience, I believe, can get better and better as we keep working with all these data sources and technology sources as well. It's great. Yeah, it's evolving fast.
I run a multi tens of millions of dollar business. How do I know what is my credit?
You don't. No one's going on PayNet. I mean, you're not going on and like checking your commercial credit. You probably have a general understanding of how well your AP person pays your bills, but you don't really know what your credit score is, what your commercial credit score.
That's the stuff that is unspoken. I'm being ranked right now. Right now, one of the things that is unspoken on top of all the margin is that every business in America is ranked and doesn't know where they stack rank. So that's where actually right now it's like the main thing I know is where we're ranked is because John I had a conversation with you, Tim I had a conversation with you, and I looked at how our company looks like. So that is actually one of the key things as you apply for credit. Just ask the person you're with, hey, how do I rank? What is my information? What's public? What's not public? I realized it was like that like we have multiple branches across the US. We have multiple entities as like a business grows, and like they were not all connected. Those people had a partial view of what was machinery partner. So that's the piece. I love the blank stare. I'm like, shit, well, there isn't an easy way to do it because even each bank is re-ranking and that's their pseudo proprietary box. The reality is the data is the same. David, you're like, people create like a fake mode where like right now it's about that transparency because directionally everyone is converging on the same models directionally. So nice. That's something that is not spoken enough about. About 80% of the heavy equipment and industrial machines bought in the US are non-manufactured in the US. That has an impact on the cost of this machine, the tariff and all that. That has an impact on financing. That has an impact on the financing of the dealers. A fun fact for everybody, speaking about data, over the past 5 years, 200 new equipment manufacturers came online on the back of electrification, new telematics, new ways to build innovation, and most of them lack the distribution network, specifically on the finance side. And what is unspoken, David, what do you see from a vendor standpoint, from an OEM standpoint? What are their finance issues themselves as a factory based in Austria, in Korea, in Japan, in Wisconsin? What does finance mean for them, and what's their issue?
Yeah, I mean, I think it's pretty simple. It's working capital, right? So, some factories are being able to tap into government subsidies to make it happen. But a lot of our factories are just like, I wish I could build more. I wish I could secure lead time better for you, but I am tapped out. I don't have more money to spend on getting my components and my raw materials to get going. So there's a need for working capital and creative solutions around that for factories is what I'm seeing on the supply side as a real need.
So that's like margin are shrinking, more volatility, new player coming in the finance market, an opacity of how everyone is ranking, leading to actually the need of multiple solution across the board. And that is all bleeds into actually needs for new partners that allows to actually select and navigate that complex ecosystem. Uh, I think we spoke about a lot of things that are not public in the market. I'll go around and ask everyone to share something that is not public about our market when it pertains to heavy equipment and about finance. John, do you want to go first?
I think it's important to know, and I think what our mission at Mazo has been, again, not the plug for Mazo, but something that I think probably has led to this conversation, right? Is commercial financing is not the same as consumer financing in that in a lot of states and based on the structure of the loan that you're receiving, there is a lot of opaqueness, Clem, as you've mentioned here, as to what the actual terms of your loan are, right? What is your interest rate? What are the monthly payments? What's your payoff policy? What are the hidden fees included in the loan? So throughout the last, let's call it 50 years, there's been an increase in the number of structures and leases and different finance agreements that have, in some cases, been meant to confuse customers, right? That's obviously taking a pessimistic view of things, but there are players out there, and we see it every day. There are players out there who want to mislead customers and get them in to loans or into leases that they do not fully understand because of the margin that the finance company can make. Mazo from day one has been a proponent of let's sell the APR. Let's sell the true rate to the customer. If it's a 60-month term at $1,000 a month, let's tell them what their interest rate is. Let's tell them what their payoff policy is. There are only 2 states, and there are 4 or 5 other states that have passed some form of commercial financing disclosure laws. It's still kind of up in the air as to if there's going to be a state by state patchwork of commercial finance disclosure laws or if there's going to be some federal disclosure law. But California and New York were kind of the torch bearers in you need to disclose if it's not a lease, you need to disclose what the APR is, what the payoff policy is, what the total cost of the financing is. And to me, I would love for the entire United States to operate under that same model because I think it levels the playing field and allows people who are doing business the right way to win and people who are doing business the wrong way to be exposed.
So, things that is not public, commercial finance is unregulated in the US, but in 2 states, and that's actually fairly new. I'll give you a fact. About 2/3 of the commercial commercial credit structure in the US will be illegal in Europe. Not that Europe is perfect. I'm American. I love the US. I'm also European. I love Europe in so many ways. But that is like there are parts of the world that say this ain't legal. This like opacity of terms, of payoff, of like buyback. That's a great insight. Team David, who wants to go in?
I'll piggyback on John, your sentiment about the consumer industry a little bit. And while it's partially public, it's not really being thought about a lot right now. I think the ability for consumers to get financing and to work with lenders right now is amazing. Any one of us right now could turn around on our browser and get a mortgage for $300,000, $500,000, probably in 5 to 10 minutes online really quick. The equipment financing industry has been a little bit slower to this market. It's more complex. There's a lot more going on. There's commercial credit and all sorts of pay histories and bank statements, all that stuff, but it is coming. I think that's kind of my hidden secret, maybe if it's not known, is that I think the technology emerging to harness all this data and put it all together at the same time with multiple lenders, I think gives the entire market a better approach by leveraging tech to solve B2B lending to make it more consumer like and make it friendlier overall. And that's coming for the entire industry, which is very exciting. So that's my last little tidbit to kind of see where the forecast hopefully is going for it.
I love all the answers so far. Maybe I'll just share my final insight. Look, I think for consumers thinking about equipment purchases, like oftentimes that machine or that piece of equipment can pay for itself. And if you look at the monthly payment, we see machines that pay for themselves and operating them 4 or 5 days. Think about that. You just have to run the machine 4 or 5 days and you pay for your monthly loan. Everything on top of that is extra that you put in your pocket, which is amazing. And so I think, think about that as a consumer. Like, how do you pay this thing off? And there's lots of calculators out there. And then there's a bunch of hacks that you can do to like even sort of game the system for you, right? There are tax incentives, right? Where if you could be tax exempt, if it's a certain industry in certain states, you can lower your tax burden with things like you've heard John talk about, right? This Section 179. We have videos on that where he's a real authority on speaking about how to maximize your tax returns. There's all kinds of things like that. So there's depreciation and other things. So anyway, that's a sort of a takeaway of like it's pretty insightful when you see the data.
There's just so much. Our goal was to have this conversation to give a starting point for someone looking at equipment purchase and looking at financing and the combination of both to unpack what does that mean to create this partnership with my vendors, creating this partnership with my lenders. Is my traditional lender the right lender? There is a lot to go through. We could have easily covered many hours on that, but the goal was to give a high level snapshot as of mid 2025 with the most volatile market that there's ever been. That was a great conversation. Nice. Hey, let us know how we did. What you would like to hear more about. Our goal will be to come every week with this group, with other people, like to speak about what does that mean to own heavy equipment? What does it mean to sell heavy equipment? What does it mean to fix it? Like and unpack that reality that is unspoken knowledge that is hard earned, that is very contextual by segment in the market, by profession, and where people get into this world of heavy equipment, as you pointed, John, Tim, like sometimes through inertia, in the context you, David, and I, like through intentionality, because that was our background, wanted to jump more into it. But regardless, like we learn every day new permutation of how that world works, and our goal will be to share that here. Thanks, everyone. Excited to do this first podcast together. That was great.